Hello everyone and welcome to this special podcast at IIM. Today we are exploring the new financial order, India's next leap, a phase where policy, capital and behavior are coming together to reshape India. Today we have with ourselves Ms. Nusrath Farheen, director at EY with 14 years of experience. She is a chartered accountant by profession, which she has helped a lot of companies to set up GCCs in India.
Thank you for welcoming me here. It's a great opportunity.
Thank you for joining us. So Ms. Nusrath will have some question which will be academic and from an MBA perspective, and we would really like to have your perspective on those questions. I hope it will enrich us and the students who are listening to us.
I hope to do my best.
To start us off, when you look at recent tax changes and policy changes in India, do you see them as just reforms or as signals of a deeper shift in India, how India wants capital to behave?
I think it's both, to be honest. They are reforms with an intent to bring the change, right? A change doesn't just come with small changes, they have to be a big impact change. And I think that is what the government has been trying to do. And it's been a trend, if you've noticed in the last few years, not just this one change, right? Way back when the GST itself was introduced, it was a complete change from the traditional VAT laws and service tax laws. While the essence remained the same, the way it got implemented, the way it got consolidated across the country, that was one beginning of the reform in some sense, right? And over the last few years, the tax laws have been with an intent of simplification. If you would have heard the finance minister in the budget speech, every year in the last 3 to 4 years, one common theme that comes across is how to simplify and how to make it more easier for the taxpayers. Classic example is introduction of the concessional tax regime, as we call for individuals, right? You don't have to go and submit your proofs of deductions because now you don't need to really carry those with you, in the sense that you have a tax regime where you do not need to claim a deduction, but you're still able to lower your tax because the tax rates are beneficial. So it's really a journey that has been, I wouldn't say this is the only step or only change that they've brought with that intent. The intent has always been there for the last few years, and they've been trying to introduce small things little by little to bring that change, because you can't surprise taxpayers, right? You'll have to create that that theme for them to understand that yes, this is where we're going to eventually.
So from manager's perspective, if we think, so you guide a lot of companies and everything. So do you think that managers are, after this tax reforms, are thinking to build their business in the longer term rather than going short terms, Q to Q, quarter to quarter results, and they want to focus more on having a big impact? Are these tax reforms which are happening are helping them too, and how your advices are helping them in such decisions?
See, what I've understood in my various years of experience is businesses don't only look at Q1 to Q2, quarter to quarter results, right? Of course, that they do matter because then you've got your stakeholders looking at your performance, monitoring your performance on a regular basis. But a business can't sustain if you're only looking at a short term. There's always a long-term plan. There's always a long-term vision that you will need to have. And tax does play a role in the sense that when you're having your investment, when you're making your investments into business with a long-term vision, what tax implications should I as a businessman really be aware about and factor in my business plans or investment plans, right? One uncertainty that most of these businesses will have is, will the tax regime remain the same? What changes is the government likely to bring in, say, 3 years later, 4 years later, which is going to impact the decisions that they're taking today? And that's one uncertainty I don't think anybody has answers to. You can only take your decisions based on the law as of today. Yes, in some sense, be prepared for the fact that this is likely to change, and if it changes for the worse, what could happen? But you can't take decisions on what may or may not happen later. So the quarter to quarter outlook is more for keeping the stakeholders happy for an immediate basis, but for a business to sustain, to grow, to scale up, your long-term vision is very, very important, and you can only take those decisions based on the tax laws as of today, and hope that they don't change a lot, where it kind of creates a full mess for your decisions as well.
Just a follow-up question, that whether this tax regimes is helping them to have extra cash flow, which is making them to build their brand a little bigger, like they have extra cash flow to build their brand more now.
Yes, I would say so, because if I were to look at some of these companies, when I were to compare the ETRs of large companies, about 8 to 10 years back, the ETRs would have been anywhere in the range of 30% plus, because that was a base tax rate, right? There was a period when for manufacturing companies, the tax rate was as low as a 15%. So you're really looking at 13 to 15% of a reduction in the ETR for those companies, right? So for other companies also, the rate of 30% is no longer relevant. We're talking about an effective rate of 25.17%, whereas it was about 33 plus a few years back. So that 7% clearly makes a lot of difference. Not just in cash, but of course in your earnings per shareholder. But and while this is on the company level, individuals, again, if you see today, who would have imagined that you wouldn't have to pay tax if you earn less than 12 lakhs, right? We always used to talk about a basic exemption limit of 2.5 lakhs. At the most, maybe we were hoping that it would be a 5 lakhs. Thankfully, it went up to 7 lakhs with some rebate system. And now it's gone up to 12 lakhs. So this clear saving for an individual as well. Cash availability in both hands of the individuals, obviously leading to better consumption and therefore better demand for the products that the companies are today manufacturing. And for companies to be able to invest that cash that they are saving on account of taxes is again going back in as a capital into the system. So it's really both ways. It's helping the economy have
Ultimately,
a better,
increasing the cash flow overall for everyone.
Absolutely.
So I have a question related to this topic only. It's a bigger one. So the budget of 2025 increased the disposable income via personal tax cuts, and the RBI has also cut rate and injected liquidity to support the growth. At the same time, we are seeing very low CPI prints, largely because of food inflation has been negative in some months, and households are increasingly shifting from bank deposits to markets. So, from your lens as a tax and policy practitioner, do you think government and RBI actions are intentionally accelerating this financialization of household savings? And does the deposit to market shift create any genuine asset liability risk for banks as rate cuts transmit faster to loans than to deposits?
That's a very big question, and yes, it's a complex question. My 2 cents on this. I would say that they are intentional. RBI's objective has always been to make sure that the inflation is under control. The risk within the liquidity market of the country is more stable. Again, from a government's perspective, their idea is to grow the economy, right? Eventually, that's really grow the economy, increase the employment. These are some of those very tenets they'll have to really work on. All of these, I would say, are very in sync. Some proactive, some reactive, right? Because one of the factors that also kind of impacts organizations in India, because we're very, very exposed to foreign currency risks, that also has a play. I think it's really, if the government and RBI were not working in sync, then I think it's really a bad situation to be in for a country, right? Your central bank says one thing, your government says one thing. Who do we really follow? I mean, what do we really do about it?
So yeah, Going ahead, I have a question from again a managerial perspective, because really want to know what is in the head of a manager when they look at all of these increasing in the retail investors and everything. So as we have seen, there is a spike in the retail investors amount who are like in the shares and everything. So do you think, what, like, you are in touch with a lot of managers, you take decisions for them, so how do you people take it as, like, it's a stabilizer, it's a risk, or it's just herd behavior which is happening around this, because they have more cash flow and liquidity in the market right now? So
See, there's a lot of the perception is very clear for everyone that investment in FDs, for instance, is certainly not yielding them the kind of result that investment in capital market is. Of course, capital market comes with risk, but it's enough and more said that if you're investing, you better be prepared for the risk that it comes to you. What I think is there is certainly a herd behavior, but it's not entirely herd behavior, right? There is a conscious effort in people today, young and old, to be able to create wealth. Wealth creation is eventually the objective. How we go about it, whether we study it properly, whether we're doing our own research, whether we're investing consciously and whether am I diversifying my investments, right? If you simply go, hear somebody say, okay, I've made some tons of money in a particular investment, and you go and invest at this point in time, it may not work. At that point in time, maybe it worked for him because the market situation, the company situation may have been different. Today it is not. So this kind of behavior is a herd behavior for sure. But I don't think the entire market is a herd behavior, right? Because there are some people who are taking conscious decisions and therefore they're seeing the results. So it's really an individual behavior. To what extent can you, and if you ask me, is it risky? Yes, it is risky. Both, even a conscious investment, a person is trying to understand how the market is making a calculated guess, but eventually it's still a guess, right? But it's a calculated guess, and he's studying the market every day, taking a call whether he continues to, he would want to continue retaining his investment or he would want to exit out of it. So it's still a risk, but it's a calculated guess, and that is when you really make money. If you're the herd behavior, I would say, is I can't put a number to it, but the herd behavior is the one like we've seen in FNOs some time back, right? That is clearly a herd behavior. You wouldn't want to do that today. Lessons learned, yes, and I'm hoping that those kind of lessons have actually helped people understand that they can't do the same thing. They'll have to be more cautious. But at least organizations, when I talk to the CFOs, clients, or say friends and peers, right? I think there is the education of financial wisdom is increasing generally, right? We weren't like this 10, 12, 15 years back. The number of people coming and talking to me about markets, it's growing day by day. Kids, college going kids are today investing. And I think sometimes I believe they are more aware of the market than we are at this age. So it's a mix of both, but I'm hoping it'll not stop the herd. Somebody making a loss, I'm hoping will not stop them from putting that money back into the capital, but hopefully with more wisdom and more consciousness.
Ma'am, so we would also like to have a kind of a perspective, like what were the major stepping stones or the events that happened in your life that changed your career, if you can share with our MBA students.
I think I fell into this entire profession by luck, by chance, in some sense. I wanted to do something completely different. I wanted to do mass comm as a graduation, but for some reason I decided I will not do that. I opted for a Bachelor's of Commerce degree. But I realized that there's, it's a 3-year degree, yes, but there's no challenge in it. Padhoge, likhoge, you'll eventually pass out, no doubt about that. So that's when I came to know that there is this course which is Chartered Accountancy. I didn't know about it before, but I thought, chalo shuru kar dein. Let's at least venture into it and see where I eventually land. Thankfully, I cleared. And at that point in time, I think with the limited information I had about the course, about what opportunities I have, I only had about 2-3 options. You either to get into an auditing profession or tax or maybe a risk audit or internal audit. We weren't too aware at that point in time about the whole investment banking and those kind of opportunities. With my little experience in articleship, I knew I did not want to do audit. So I thought I'll try tax. I got into it. I realized it's where I should be. It's where I was meant to be. And I just remained in tax, and I don't think I plan to move out, at least. I like what I'm doing. So
we can take it as keep taking challenges, you'll ultimately land.
Yeah. I think what helped me was not being hesitant about venturing into new areas. I didn't know about Chartered Accountancy course before. I had no guidance. I had no friends and family in this. But I ventured. I did not know about taxes. Of course, except that there's a conceptual knowledge that I had with my curriculum. But I ventured into it. So, yeah, things pan out very nicely for everyone, I hope.
Thank you so much.
Thank you so much.
Thank you. This has been good interacting with all of you. I hope to do more. All the best to all of you.
Thank you so much. Thank you.